Welcome to the Explainer. Today, we're doing something a little different. We're not just looking at tax law, we are launching a full-blown forensic investigation. We're going to dive deep into a high-stakes financial puzzle, looking for clues inside the complex DNA of a grantor trust to secure a prize worth millions.
Okay, so let's get right into it. To really wrap our heads around this, you have to stop thinking like an accountant and start thinking like a crime scene investigator. The evidence can be complex, the paper trail might be cold, but our objective? It's crystal clear. Secure that full basis step up at death.
So our investigation begins right here, in what we're calling the tax forensics unit. And the core principle is this. A trust document isn't just a legal instrument. Oh no, it's a complex DNA sample, and it's filled with these tiny genetic markers that ultimately decide its tax fate. Now let's zero in on the big prize, Section 1014 of the Internal Revenue Code. This is the whole reason we're here. This incredible provision lets heirs inherit assets at their current market value, which means it can literally erase a lifetime of capital gains. Our entire forensic analysis is geared towards one thing, proving an asset's DNA qualifies for this exact treatment.
All right, let's open the case file and look at the evidence. We are going to analyze the genetics of a trust, right? We're hunting for those specific markers, the retained powers, the specific clauses that tell us if it qualifies for that incredibly valuable tax benefit.
And you know, what's so cool is how neatly these tax concepts map onto forensic terms. Think about it. An asset's basis? That's its fundamental identity, its DNA profile. A power the grantor held onto, like the power to swap assets, that's a specific genetic marker. You got commingled assets in the trust? That's a messy DNA mixture. And incomplete records? Well, that's just like a degraded sample from a decades-old cold case. This framework really makes it all start to click, doesn't it? And this picture illustrates the problem perfectly. You're looking at what's called an electrophoregram of a three-person DNA mixture. It is messy, it's complex, the signals are all overlapping. And that is exactly what a tax professional faces when they look at a trust that holds, say, both gifted property, which has a carryover basis, and assets that were bought with trust income. It's a commingled mess that you have to painstakingly pull apart to figure out each asset's true basis profile. You know, in a crime lab, if you have a really tiny or degraded DNA sample, you get all these weird artifacts and statistical noise. They call it stochastic variation. Well, guess what? The exact same thing happens in tax forensics. When you're missing historical records like receipts or old appraisals, your evidentiary data is low. And that dramatically increases the risk of artifacts, or let's be honest, errors, in your final report to the IRS, the Form 706 estate tax return. So, what do you do with a degraded sample? Well, forensic scientists have this amazing tool called the Snapshot Method, which can pull a DNA profile from the tiniest fragments. And we can apply that same logic here. First, primer hybridization. You hunt through whatever records you have to find one specific legal event, a purchase, a gift, that you know caused a change in basis. Second, single base extension. You attach a definitive marker to that event, characterizing it for tax purposes. And finally, the enzymatic cleanup. This is where you reconcile everything, getting rid of any unsubstantiated entries, all the noise, so the final valuation signal you send to the IRS is perfectly clean. Okay, now we come to the major turning point in our investigation. Because in 2023, the IRS dropped a huge new piece of evidence. Revenue Ruling 2023-2, and it fundamentally changed the rules of the game for every single person in this field. For years, this was the question. Planners got really creative with these things called Intentionally Defective Grantor Trusts, or IDGTs. The idea was to have the trust be owned by the grantor for income tax, but be excluded from their estate for estate tax. It was this attempt to get the best of both worlds, no estate tax, but still get that juicy basis step up. But was it legit? And then, in March 2023, the IRS came down with a definitive and, for many, a disruptive answer. No, absolutely not. The ruling made it crystal clear. If an asset is not included in the decedent's gross estate for estate tax purposes, it does not get a basis step up under Section 1014. You can't have one without the other. Period. So this lays out the new reality. It's pretty stark. If a transfer is a completed lifetime gift, meaning it's out of the gross estate, the beneficiary is stuck with a carryover basis. Simple as that. To get that coveted step up to fair market value, the asset's DNA profile absolutely must show it was acquired from a decedent. And what does that mean? It means it was included in the gross estate and was at least potentially subject to the estate tax.
And this ruling leads us directly to the strategic fallout. It has put planners and their clients in a really tough spot, forcing a difficult choice that has massive, massive financial implications. So now, you have to pick your poison. It's really that simple. Path 1. You intentionally structure the trust so its assets get pulled back into the estate. This gets you the basis step up, which is great for your heirs' capital gains, but it exposes the whole thing to a potential 40% estate tax. Or there's path 2. You keep those assets out of the estate, you avoid the estate tax, but you saddle your heirs with a carryover basis and what could be a gigantic capital gains tax bill later on.
Now, for some people, this decision is a no-brainer. In 2023, the federal estate tax exemption was a whopping $12.92 million per person. So if your total estate is well below that number, the choice is obvious. Go ahead and include the trust assets in your estate. You're not going to pay any estate tax anyway, and your heirs get that full basis step up, completely wiping out the capital gains. Easy choice.
But for larger estates, over trusts that are likely to sell assets, losing that step up can be absolutely brutal. And what's wild is just how punishing the tax brackets are for trusts. I mean, look at this. An individual doesn't hit that top 20% long-term capital gains rate until their income is over $500,000. A trust hits that same 20% rate after just $15,900 of income. It is an incredibly compressed, very unforgiving schedule.
Okay, let's put some real numbers on this. Let's say a grantor bought stock for $50,000. By the time they pass away, it's worth $200,000. If that stock is sitting in an irrevocable trust that's excluded from the estate, there is no step up. The basis is still $50,000. So when the trust eventually sells that stock, it recognizes a $150,000 gain. At the trust's 20% tax rate, that is a $30,000 tax bill. $30,000 just gone. Money that could have been completely avoided if they'd gotten the step up. And if you think this is a tough decision now, just wait. It's about to get much, much harder for a whole lot more people. See, that big estate tax exemption we have now is only temporary. It's part of the Tax Cuts and Jobs Act, and those provisions are set to sunset at the end of 2025. Come 2026, the exemption is projected to get cut roughly in half, down to about $6 or $7 million. Suddenly, this pick-your-poison dilemma is going to affect a much, much wider group of families. Finally, no investigation is complete until you file the report. So it's time to document all of our findings and present them to the authorities, who in this case happen to be the IRS, to make sure our desired outcome is locked in and officially secured. This right here is where all that forensic work pays off. This is where the rubber meets the road. Your entire analysis gets officially documented through precise, strategic reporting. And the main stage for that is Form 706, the U.S. estate tax return. This is your final report. It's where you present all your evidence for why these assets deserve that step up in basis. So what do you actually do? Here are the actionable strategies. First, you can trigger estate inclusion on purpose. You do this by drafting the trust with specific powers that fall under Internal Revenue Code sections 2036 or 2038. This is your guarantee that the assets get pulled into the gross estate. Second, you have to conduct rigorous valuation forensics. That means getting qualified appraisals for every single asset to definitively prove that new stepped-up basis on Form 706. And third, it's really worth exploring alternatives now, things like preferred partnerships, which might just offer a more flexible path for managing basis in this new world.
And that leaves us with this final, critical question. The tax code is never static. It's always evolving, always mutating. With a huge change just over the horizon in 2026, the environment is about to get a lot more hostile. So you have to ask yourself, is the genetic code of your estate plan prepared to survive? Because right now, a full forensic review isn't just a good idea, it is an absolute necessity.